Others has to actively participate in this presentation, right? They have to ask question. Angane. Kula tu time angane. Don't have kula lapin mati. So you have to, you have to ask question, right? They want to run anything on it. Nothing. Make a run. The reason is that so one of these question will be make a blend in the exam context test kara. So therefore you should have the understanding of the others who did that the time. Copy. Right, the first thing you introduce your team and the topic, the area others doing, then you can start. Can start.
Good afternoon, all of you. So we have group 1 here. So we are here to present about the Taxation of cross-border infrastructure project. It's the case study between a company called LNBC and ADC. So this is under Sri Lanka and Vietnam. These are myself, Nancy. I took the past introduction and the presentation. So in a picture, she was one who made the content about the permanent establishment. And Anjali, she made the content about the income classifications. And then Lusvik, he is the one who did about the tax liability according to this case study. Now, majorly, he is absent and didn't contribute to any content. And J.R. Rahmat, he is the one who did the DD analyzation and function. So, to introduce our case study, there is a company called ND Construction, which is established in Sri Lanka. So they have on a bid in Sri Lanka's National Transformation Plan to build a project, an urban corridor. So for that, they engaged with a company in Vietnam called Logistic Network Vietnam Company. From now on, we'll call it as VNVC. So from that, with that company, they have engaged in this project. So from LNBC, they have under the contract, so they have split the contract into 2 agreements. One is to design and fabrication of the components to make this urban corridor. So for that, they have budgeted for 180 million USD under 3 months. So these components are engineered and produced in Vietnam and shipped to Sri Lanka. So the second agreement is for the on-site supervision contract. So by doing the installation over here in Sri Lanka, so to oversee the supervisions, to send some expert into Sri Lanka for 100 days, and the budget is 70 million for that. So the LNBC company is established in Vietnam, but the components made in Vietnam and installed in Sri Lanka, they are shipping inside to Sri Lanka. So when it comes to the resident status analysis, LNDC is fully incorporated and managed in Vietnam, so they are considered as non-resident according to the Sri Lankan context. So LNDC is a non-resident. And when it comes to the employees who are coming to oversee the installation, they are going to stay here for 110 days on site, and they are Vietnamese nationals. So they are also considered as non-resident individuals because their presence is less than 183 days. For the next topic, I will
Another 3.1 about the design and certification. Done entirely in Vietnam. So this is the income point. So it's not taxable in Sri Lanka. Unless Vietnam so much and the permanent settlement here. And our storage is carried out in Sri Lanka. The services are performed in local, so this is like complex process. With the corporate entities, 30%. The construction and the local payer, the one before the tax before the tax before making the payment. Then, for this, logistic network data staff staying only on the 10 days. So they are treated as a member. So they need to pay the tax on income within the Sri Lanka. So the employment income related was tax progress. Then finally, NB construction has the obligation to direct and regular board. It also should not prohibit create the money, and various employees' salary. The double tax agreement ensures by the taxes by the Sri Lanka and include the rates by Vietnam.
I'm here to explain about the double tax avoidance agreement between Sri Lanka and Vietnam. And it's a treaty between two countries for the purpose of avoiding the double tax. The key features include here is permanent establishment, which is PE. It means when a business present in another country generates taxable profits there. And employee and resident taxation and relief methods like tax credits. And here, as per the case study here, the agreement one, which doesn't contribute a PE in Sri Lanka. So the 180 million and those profits is taxable only in Vietnam only. As per the agreement two, which has a service PE in Sri Lanka, because more than 90 days they have worked here. So as per the article in the double tax avoidance agreement between Sri Lanka and Vietnam, it promotes a service PE. So their profits in the agreement 2 is 20 million basically, and that is taxable in Sri Lanka. And as per the employees are concerned, their salaries are paid by LNBC. So there's no individual contribution from consultancy or supervisory service contributed from there. So no pay taxes deducted from them. But as per the article which is mentioned in the agreement, supervisory staff in Sri Lanka who is staying more than 180 days should be paying pay taxes. And as per the article 5, and we in Sri Lanka pay salaries, so they should deduct WHD from them, as the NDC will be liable to deduct WHD. And the double taxation relief means it will be Sri Lanka. That means if they pay here, they will be getting a credit in Vietnam. As per the agreement 2, they are liable to be taxed in Sri Lanka, so they will be getting a tax credit in Vietnam. As per agreement 1, they have been only liable to pay tax in Vietnam. And as per the employee issue is concerned, if they are liable to pay in Sri Lanka, they also will be getting credit relief from our end. And next time, PowerPoint.
The recommendations of the fellowship establishment are basic rules, the structural rules, agency type, PE, and service type, PE. The inevitable act of doing for professional activity is the introduced the concept of establishment as Sri Lankan PE and foreign PE. The rate is what the double taxation is
2 minutes.
Vietnam and Sri Lanka introduced the learning establishment concept here. And in introduction of the project, the first step of the PE concept. Specification under the
Any question? Nah, නැත්තම් ඔය ගිහලා කියන්න ඕනේ මං අහන ප්‍රශ්නෙට උත්තරේ. මගාව දෙන ප්‍රශ්න අහන්න. No question? Good. Right, so I have issue with your, can you go back to your let me know whether there is a permanent establishment or not.
Agreement to fix the lowest fee is there in Sri Lanka.
Yeah.
The article mentioned the giving supervisory service 90 days in Sri Lanka, that service fee which will make them liable to pay tax in Sri Lanka.
Okay.
Yes, sir.
So then, as per the agreement two, I mean the part two of the agreement, so there is a
Profit, they have mentioned the profit also.
yeah.
They have said that they cost 50 million. So there's a profit of 20 million
Yeah.
profit.
Yeah.
So that profit is taxable in Sri Lanka.
So then the employment part.
That one, the general stuff I included. That is not relevant to our case study. As to our case study is concerned, there is no employment tax promoting. But in the ETA in Sri Lanka, Vietnam, there is a point about employee taxation.
Yeah.
So I wanted to just inform that there is a concern like this.
Yeah, I mean
that doesn't
you
promote.
mentioned if they are paying tax in Sri Lanka, they can get that tax. Yeah,
Yes.
I want to know whether they are liable to pay tax in Sri Lanka or not.
No, sir.
They are not.
The individuals who are working here,
Yeah.
that means the agreement to
Yeah.
states that from LNVC, they have sent their employees to Sri Lanka to work. But from NDC, they are paying to LNVC. LNVC is the one who gives those employees the salary.
Yeah.
Therefore, those employees doesn't give an individual service or a open service to Sri Lanka. They are liable to LNVC, that company.
Right.
So they don't promote to pay taxes in Sri Lanka because the rule is they should work more than 180 days, but they haven't completed that day in Sri Lanka.
No, if they are working here more than 100 days, they are liable to
They are liable to pay in Sri Lanka.
Is that the case?
Yes, sir.
Because of they are not working in Sri Lanka more than 100 days, they are not liable to pay tax in Sri Lanka.
As per that agreement.
As per the agreement.
Yes. The DTA, that's what they are.
Which I mean the research
NDC pays them this 70 million, they should be holding WH, 14%.
LDC not paying to the employees?
No. They
Yeah.
are paying to LNVC. But
Correct.
they are,
Correct.
yes, sir. This promotes the supervisory service. So
Yeah.
they should be holding a 14% WST. And as per this company is liable to pay profits in Sri Lanka.
Yeah.
So that WST can be calculated. If over, they will be refunded or credited. If not, the company will be liable to pay.
No. Two things. One thing is when they are making the service fee payment, you are telling that we need to deduct withholding tax.
Yes.
14%. Yes. That we mean Sri Lankan company paying to Vietnam company, you know?
Yes.
So Sri Lanka company has to deduct withholding tax.
Yes.
And again that 70 million minus that expenditure, on that we have to work out that profit.
Yes.
On that we have to pay tax in Sri Lanka.
They should pay tax in Sri Lanka.
Who?
LNBC.
Yeah.
Because they have exceeded the 90 days target.
Correct.
So the WST is holded in Sri Lanka
Correct.
already.
Yeah.
From that 70 million.
Yeah.
And they are liable for the 20 million.
20 million. Yeah.
So the difference in between can be settled also. If the IRT will give credits or refund, or else if it's more, they should be paid to Sri Lanka.
Fine. So okay. So then in your area, so you have mentioned 250 something. What is that? Yeah. Total now contractual year 250. On that, are they liable to tax in Sri Lanka? I have mentioned 250. Yeah, 250 correct. One is 180, two is 70 correct. 250 total agreement cost. I mean total project cost, but we are given to the Vietnam company 250 worth of projects, right? I mean, are they liable to? Why you have mentioned that one? I told you. Fine. No question, right? Fine. So what you mentioned is correct, but that why is the because is the approach to this type of question. Actually, this is what is, you know, what this project. Lanka, but this toll road, Kajigiri. Right? So based on that thing, I have developed this question. So this type of question, I mean, the approach to this type of question, but I mentioned that how to approach. So you were here and there, that's fine. Thing is that first thing we have recognized who the person. That first slide you have correctly mentioned that they are non-resident employee, that's correct. But in case of the employment income, it doesn't say that. As for the first thing is we have to check the domestic law. As per the domestic law, because we determine is whether they are resident or non-resident as per the domestic law. Right? Then domestic law says if the employment is exercised in Sri Lanka, irrespective of whether where the payment is coming in, they are chargeable for Sri Lanka tax. It's treated as their source in Sri Lanka. That's the domestic law. There is no reference to a number of states because still they are non-resident. Because in case of the non-resident, if there is a source in Sri Lanka, they are chargeable for Sri Lanka tax. Source in Sri Lanka means in case of the employment income means if they are exercising employment in Sri Lanka, yes, there is a source in Sri Lanka.
Even if it's less than 100 days.
Yeah. But having said that, you have to refer to the Article 14. If that Article 14, and it says, first para says yes, the same provision. Second para says there are three conditions. If these all three conditions are satisfied, then they are chargeable for tax again in Vietnam. Resident countries, taxing right. So that type of question you have to approach in that way. First thing is the status of the resident. Second thing is if they are non-resident, then whether they are source in Sri Lanka. Yes, they are source in Sri Lanka. Then they are chargeable for tax as per the domestic law. But double tax avoidance agreement then come and play this thing. Okay, how it's happened. The first part also says that first part that agreement is concluded and everything is happening outside Sri Lanka. Non-resident person doesn't have a source in Sri Lanka. That's why they are not liable. Otherwise, they are chargeable. Right? Okay, right. Thanks. And because you have information to work out the tax exposure. Expenditure income ඔක්කොම detail දීලා තිබ්බ පැරා එකේ. quantify කරන්න ඕනේ. So it's back. දෙකද? මේ ඔක්කොමලා මේක ඉන්නවා. මොනවද දැන් හය. කොහොමද කන්ට්‍රිබියුට් කරලා? කවුද තේ ආදායම leader? The 48%, right? Right, going fine. What level? Right, you can start.
And yeah, you have to present all the tax implications or
Limited Private Limited. It's about the tax implications of cross-border business expansion. So, it is a I'm Sadhana, and I prepared the full content and drafted the introduction and summary table. So the second one is Ratnayaka. She is analyzing the resident status of company and employees under DTAA. And Adolphus, she will discuss about PE definition under Article 5 of DTAA. And Nuska, she examined the taxation of PE profits under Article 7. And Amjad analyzed taxation of Sri Lankan employees and Indian secondary under Article 50 payrolls. Last one is Srika. She explained Article 23 of DTAA, methods for elimination of double taxation. So let me start with a brief introduction to our case study. Limited Private Limited is an Indian company. It plans to expand into Sri Lanka by building a digital warehouse management facility. So they have signed a 30 years of lease agreement with Serenity Logistics. It's a Sri Lankan company, and to develop and operate the warehouse in Sri Lanka, and also will employ 2 Sri Lankan nationals with salaries paid from India to their Sri Lankan account. And also, they will hire a senior Indian staff member will be seconded for 3 months to oversee setup and salary paid in India.
Explain the resident status and the tax liability regarding the limited private limited. So, when it comes to the compared resident, the company is a Sri Lankan tax resident. If any one of the following is true, is the criteria. It is incorporated under the Sri Lankan law. It's registered or principal of its in Sri Lanka law. Its management and control of the business are exercised in Sri Lanka. Then, if this criteria is not applied, the particular company is not resident. When it comes to the medical private limited, the company is treated as the non-resident because the company incorporated and managed in India. So this is the non-resident company for the Sri Lankan tax purpose. Then I move to the resident status and the tax liability regarding the Sri Lankan and India employed. For that, I use this table. For the resident state, as the Sri Lankan employee reside in Sri Lanka, as per the domestic law status, I classified as Sri Lankan employee is tax resident. With the Indian employee, he stayed 90 days, so which is less than 183 days. According to that, he is a non-resident person. And in the DTA, Sri Lankan employee, salary is taxable in Sri Lanka, and the Indian employee he treated as a resident of the India. And in finally, the tax liability, Sri Lankan employee liable for the Sri Lankan tax waiver, and the Indian employee is not liable for the Sri Lankan tax. Then I invite the Nisha to. According to the our case study, I will discuss about the permanent establishment analysis. So when it comes to the Article 5 in Sri Lankan India DTAA, a PE is a fixed place of business through which the business of an enterprises is wholly or partially carried on. And in Article 5.2, it specifically indicates a warehouse in relation to a person providing storage facilities for others as a form of PE. So, according to our case study, the 30 years lease agreement of the Sri Lankan warehouse constitutes a fixed place of business meeting the DTA definition of a permanent establishment. So when it comes to the implication, Meditech company's warehouse in Sri Lanka qualifies as a fixed place permanent establishment under Article 5, and only profits derived from operations in Sri Lanka are taxable here. Profits related to solely to head office operations to India remain taxable in India. Under Article 7, business profits, profits attributes to this permanent establishment are taxable in Sri Lanka. So when it comes to the expenses directly connected to the Sri Lankan PE, including part of management and administration costs, can be deducted when calculating the taxable income as permitted under Article 7.3. And since the facility is not used solely for preparatory or auxiliary purpose, Article 5.4, it does not fall under DTA exclusion. So to talk about taxation of Meditech private limited business income in Sri Lanka, I would like to call upon Nuska.
We're talking about the taxation of the business profit. According to the DTA, business profits are taxable only in India, but that depends on the permanent establishment. Meditech has a permanent establishment, so it is taxed in Sri Lanka. And according to the article number 7, it clarifies the profits are attributed based on the permanent establishment actual activities. And when it comes to the Sri Lankan Income Revenue Act, the Sri Lankan source of income of non-residents with the permanent establishment is taxable. And the corporate tax rate is 30%. And the deductions are allowed like indirect permanent establishment expenses, and they have a threshold of maximum 10% of the permanent establishment income. So I'm calling for no. We're talking about the taxation of employees listed as a limited. There are two Sri Lankan employees. According to Sri Lankan law, if any person stays in a country more than 183 days or more, he is considered as a tax resident. So the Meditech two employees, they are taxable in Sri Lanka. They are subject to Sri Lankan tax, and they are taxable in Sri Lanka. So their worldwide income is taxable. And the other parties, Indian senior. So there is a small change. I'll go ahead and explain that. Here, the Indian, according to the Article 15 of the Sri Lankan DTA, a person working in the other country, I mean Sri Lanka, is normally taxed in Sri Lanka, but there is an exception. There are 3 conditions. If these 3 conditions are met, he is only liable to tax in India. So the first condition is he stays in Sri Lanka for less than 183 days, and his tax is paid by outside Sri Lanka. And the third condition is his remuneration is not borne by the permanent establishment in Sri Lanka. So all these 3 conditions are satisfied. So only the home country, India, is taxable. So here in India, it's taxable, not in Sri Lanka. Yeah. So to talk about the next part, double taxation within the compliance of double taxation means double taxation happens when some income is taxed by one country. Indian example of the article, India and Sri Lanka, then create a financial risk for the cross-border entity. That's why avoiding issues. So double taxation solutions. These are credit methods. So I will point out the credit method and mutual tax relief and extends with the progress. So when we focus about the Meditech private limited, we focus about the Meditech private limited. They are also in the Sri Lanka, both Sri Lanka and India and Sri Lanka put tax in the same income. So that's why in this
Medical is a permanent establishment. Profit tax in Sri Lanka. Foreign currency exchange, that's why only permanent establishment. So here complaints and employee tax medical private limited. Sri Lanka employee. Sri Lanka employee salary source income source is Sri Lanka, so that's why here we are taxable for Sri Lankan employee. And Indian secondary employee 180 less than 183 days according to the Article 23. And Sri Lanka taxation is Indian employee not taxable for this contract. And Indian Act Section 75 and DDA override local law and Section 80 and 97 foreign taxation credit allowance for complaints, and complaint states are registered PE permanent establishment with the Inland Revenue Department in Sri Lanka, file annual tax return for the maintenance resource. So I would like to conclude this presentation. It is the summary of tax exposure. For Meditech Private Limited, net of income is business profits from warehouse, and yes, it profits attributable to the Sri Lankan PE are taxable in Sri Lanka. And for Sri Lankan nationals, that means an employee, yes, fully taxable in Sri Lanka as trading residents. And for Indian staff, there should be a small change adjustment that should be made. They don't have to pay tax, they don't tax liable in Sri Lanka because the cost is not coming from Sri Lanka. The cost is not generating from permanent establishment in Sri Lanka, and also they are staying here less than 183 days. Yeah, that's it.
Now it's time for your question. Question. එකටත් නැහැ. Yes, ask.
His remuneration is paid by outside Sri Lanka, and his remuneration is not bound by the PE in Sri Lanka.
I don't know the liable කියලා.
Yeah, that's why there is not connection and
Right. That's only one question. Right. No, I mean in that way, to go to that area where that employment income is taxed and that part Sri Lankan and even summary. So another one. Yeah. Other one. Yeah, this one. So why you are referring that Article 4 and 15 in Sri Lankan approach?
Lankan employee reside in Sri Lanka, so that's why they are
Article 15. Even that why the residential is test, you have mentioned reside in Sri Lanka for the more than 180 days. The residency test that says reside in Sri Lanka, right? Or what is that slash more than 180 days? Both conditions are satisfied because of that thing resident or what? What's the meaning? Fine. Okay. Good. Yeah, I mean small thing. So if somebody is resident in Sri Lanka, we don't worry about detail. That's what I want to highlight. Because they are anyway resident. They reside in Sri Lanka, so DTA not applicable. Domestic law is applicable. So non-residents, yes, then DTA applicable. Fine, thank you. Okay. You do the markup, like, yeah, markup. Yeah, they have to wait.
A very good afternoon, sir. So ours is about the DTA between Australia and Sri Lanka. Let me take you through. So about the case of the residency status will be done by me and Selena. P on the DTA by Habara. Business income and taxing rights by Nesme. Dependent personal services by Angelo and Theodore. And conclusion by Farah. So if I were to take you briefly through the case, TKT is a Sri Lankan company that contracts WAI, an Australian company, for consultancy services to revise its marketing strategies. So the agreement is done in 3 phases, which is the field work, then the comment with the strategy development, and the implementation status. And the field work is done for a very short time, whereas most of the consultant services are done online. So that's a brief. And moving on to the residency status. So it is important to determine the residency status for taxable purposes. So a resident is taxed wherever the source arises, whereas a non-resident is taxed to the extent that the income is derived from or arises in Sri Lanka. So for a company to be considered a resident company, there are three principles or conditions that it needs to satisfy under the Inland Revenue Act, Section 69A. So the 3 conditions are: it needs to be incorporated or formed according to the laws of Sri Lanka. Second, it needs to be registered or have a principal office in Sri Lanka. Or third, during the time of management, the control or the effective control needs to be exercised in Sri Lanka. So as per our case, WAI, which is the Australian company, it is incorporated in Australia. And the effective management and control is assumed to be in Australia as well. So therefore, it can be concluded that WAI is a resident of Australia and is a non-resident company of Sri Lanka. Over to you then. The concept of permanent establishment in under DTA. So the permanent establishment means a fixed place of business through the business of the enterprise is wholly or partly carried on. There are types of PE, place of management and branch of office, factory, workshop or mine, oil or gas wells, other place of natural resources extraction, agricultural or forestry property. In addition, service fee is furnishing of consultancy services in Sri Lanka for periods exceeding 183 days within any 12 months of period. If we apply this to our case study, we can see that WhatsApp's marketing team was Sri Lanka only for 1 month, which is does not meet the 183 days. And the core consulting services was conducted in Australia, and also we can see that there is no fixed place of business, and that does not meet the criteria of CE. Taking about the summary, we can see that it did not establish a fixed place of business in Sri Lanka, and also did not exceed the 183 days threshold, and they conducted their operations in Australia. So we can came to conclusion, but does not support the permanent establishment in Sri Lanka. Okay.
According to the Article 7, business profits are only taxed in the country of residence, which in our case is Australia, unless the business operates for permanent establishment, which in our case is Sri Lanka. And if a PE exists, the profits that are only attributable to the PE are taxed. So in Article 7, according to our case, the resident country Australia can tax the business profits of TKT, and Sri Lanka cannot tax its business income. And if a business operates through a permanent establishment, only the profits that the PE would earn as an independent or separate enterprise can be taxed. Since there is no PE according to Article 5, the Article 7, paragraph 2 is not applicable in this case. Over to you, Angela.
So I'll be talking about the applicability of Article 15, which is the dependent personal services. So in this, before moving on to the paragraph 1 and 2, if I say about the employees of non-residents, so Australian employees, basically they are not freelancers as well as they are not independent consultants. So actually they are paid and controlled directly by the Australian company. So we can clearly put their remuneration under the dependent personal services as per the Article 15. So if you look at the Article 15, paragraph 1, which is a general rule, the remuneration derived by one contract is, say, if we say Australia are taxable only in that state. So if the employment is exercised in Sri Lanka. So basically that if I would say if the employment is exercised in Sri Lanka, then Sri Lanka also gets the taxing right. But there's an exemption here. So in the paragraph 2, it says if these conditions are met, in the second paragraph, it says Sri Lanka cannot tax the remuneration of Australian employees if these 3 conditions are met. So if we say if these 3 conditions are not met, then Sri Lanka can tax, obviously. So the conditions are if the Australian employer stays in Sri Lanka for a period not exceeding 183 days, and also the remunerations, salaries are also paid by the non-resident employer, and also the remuneration is not borne by a PE, which is established here in Sri Lanka. So for the application for this case, I would like to call upon Devu. She will explain you about it.
The statement that the employment status of PATAs, the employees are dependent, not a freelance or independent consultant. They work under direction of PATAs. Making preference in Sri Lanka, the employees of PATAs were in Sri Lanka for only 1 month. This is the below 180 one. Next one is employed residency. Their salary paid directly by Australian company. As per the permanent established in Sri Lanka, as mentioned, section number 2, their
there was no permanent established in Sri Lanka because all the conditions of Article 3 Section 3 satisfy the taxing rights in Australia. So, according to Section 73, Sri Lanka endeavour to act if employment is exercised in Sri Lanka by non-residents and also have a source in Sri Lanka, then they will be liable to tax in Sri Lanka in absence of but DTA between Sri Lanka and Australia overrides IRT Act. Therefore, Sri Lanka has not tax. Therefore, Sri Lanka has no taxing claim. In summary, but that's employee income taxable only in Sri Lanka, and Sri Lanka has no taxing claim over to.
Moving on to the conclusion, what I think is a resident of Australia and a non-resident in Sri Lanka under the Indian Revenue Act and of 2013 and the double tax avoidance agreement. There is no permanent establishment created in Sri Lanka as they visited only for a month, and in order for it considered as a permanent establishment, they need to stay for over 180 days. So their business profits, according to Article 7 of the BSAA, they are only taxable only in Australia. There's also no remittance tax applied as the income is not Sri Lankan. Employment income under Article 16 of the BSAA may be taxed in Sri Lanka only if staff exceeded 183 days. Overall, what-time incorporation fiscal topics are not taxable in Sri Lanka. Taxing right lies exclusively with Australia only. There I'd like to conclude our presentation. Any question, guys? No question? Right, okay, all good. I think you can have another one. I got no idea. Okay, sir. Because organically examination.
These are key members. Myself, I'm presenting introduction and conclusion. Normally, we are thinking presenting health framework in Sri Lanka. Some are presenting case model. Some is presenting sales model. This was presenting branch office model compared to an initial model. This has the presenting dealer model. This is our table of purchase. Introduction. Today we will be presenting our study on the potential tax exposure in India private limited. it enters in Sri Lanka market in January 2024. SIL is an Indian company engaged in selling construction machinery. Since it currently has no pressure in Sri Lanka, its tax liability will depend on the mode of entry into the. We examined 4 models: the lease model, sales model, branch, office model, and dealer model, each with different implications for permanent establishment and income classification and the Sri Lanka India double tax agreement. The income may be treated as business profit, leasing income, royalty, or technical service fees under the Inland Revenue Act number 24 of 2017. In case study, we compared each model side by side to identify tax exposure, compliance and treaty implications.
Corporate taxation is mainly governed by the Inland Revenue Act number 24 2017. For a company like India, which is incorporated in India, the level of corporate framework arises when they are entering into the Sri Lanka network. Different companies that have from local income and the companies that have from the Sri Lanka income. So, when it comes to corporate establishment, corporate establishment will be service, place of management, or even in Sri Lanka. So, if a PE is established, applicable taxes are corporate income tax, withholding taxes, and branch tax capital. And the Sri Lanka India double tax avoidance agreement plays a key role here. So it ensures business profits are taxable only if a PE exists, and royalties and service fees taxable at stores with WHT caps and released via a foreign tax credit.
Moving forward, we are talking about the both business model. And the first model is this model. According to this scenario, the company called Sidhu India Private Limited, which was situated in India, has an agreement with Singapore company who was applying construction machinery. According to that agreement, they are directly shipped those equipment to Sidhu company's customers who was in Sri Lanka. And by entering the operating lease agreement, according to that lease agreement, the customer has responsibilities and controlling power of that equipment, and also the customer paid his payment to Sidhu company's bank account, and also the Sidhu company does not have any location in Sri Lanka. Next, the permanent establishment consideration. Since this Sidhu company does not have any branch or office in Sri Lanka, and also all agreements are agreed and finalized in India, and also the machinery is delivered directly from Singapore, and those equipment are operated by the customers in Sri Lanka. So therefore, we can state that there is no fixed base PE in Sri Lanka for tax purposes. When it comes to income classification, the main question was rising is whether this income should be treated as either royalty or business profit. Whether if it is considered as royalty, then that can be taxable in Sri Lanka, but if it is considered as business profit, that is taxable only in India. Next, the tax obligation in Sri Lanka.
for this Sidhu company, when the payment is considered as royalty, then the withholding tax on payments is made by the Sri Lankan customer. Like that. When it is considered as business profit, then there is no tax in Sri Lanka, applicable in Sri Lanka. For Sri Lankan customer, when it is considered as royalty, the customer must deduct and remit its withholding tax to Inland Revenue Department. But it is considered as business profit, then there is no need for withholding tax payment requirement. Then
by machine company before sales in trade of the there are no copies or stocks on here in Sri Lanka, all managed in India. Customer handle customer relation rates. So it will be an income and dealership will not royalty or let's move under the India Sri Lanka DPA, copies are structured completely in India unless it will be a permanent based in Sri Lanka. This is the Sri Lanka and copies. It will BSAA also has a providing registration duties in India. The only cases are impact on customers on made paid by the customer. The main is in Sri Lanka, the data brings the economic procedure in DPA.
yeah, we can talk about dealer. So if you set up a company work with the local dealer in another company, a foreign company still owns the good, but local dealer provides services like distribution and after sales support. Usually, a contract explains what the dealer must do, how they are paid, and how much freedom they have. In our case, City India, Private Limited buy equipment from Singapore and sell it Sri Lankan customers and local dealers. Local dealer in Sri Lanka will handle after sales services and will be paid on cost plus 7% basis. But if this dealer cannot work for anyone else and will follow the training procedures and management. So the dealer is quite dependent on people. The big question is whether this dealer creates what's called permanent establishment or permanent establishment for Sri Lanka. And under the Sri Lanka India tax treaty, if the dealer acts only for C2 and under its then C2 may be treated as having permanent establishment here. That means C2 sells profits linked to the Sri Lanka tax in Sri Lanka. If not, then only the dealer's 7% margin is taxed here. And C2 pays tax only in India. So the key issue is here is whether the dealer is independent or dependent. If dependent, C2 pays the Sri Lankan tax obligation. If independent, only the dealer's profits are taxed in. So I would like to hand over to
Sri Lanka. This branch will automatically import machinery and sell it and also give it on lease to customers. So this branch will automatically consider as a permanent establishment. That means Sri Lanka has tried to tax on it, tax on the business profit that are branch name. And also while India gives tax credit, so the income is not except for it. So the branch So the branch is taxed as a local residence under income revenue act. So as per 30%, 30% corporate tax advantage on this profit. If profit are sent back to India, 14% remitted. That and also there are royalties paid to the head office. So additional 10% WST has been charged. So final number that we have is calling tax on royalties applicable. So no tax enforcement for the property. For the base model, now corporate tax in Sri Lanka, only important customers that are applicable. So the branch office, of course, they are payment establishments, that means the 30% corporate tax is applicable and average can provide the payments. Branch limited because the profit is sent back to India. Okay, dealer model, they are 17% margin that are applicable if the dealers are independent. If not independent, still intermediate. That's two. Okay.
Our study shows that Srilanka, SIL, taxes for in Sri Lanka depends on the business model it chooses. The lease model mainly depends on the income is treated as royalty or business income. The sales model has the lease risk in sales made offshore without a permanent establishments are not taxed in Sri Lanka. And the branch office model has the highest risk because branch is always a permanent establishment. So profit will be fully taxed here. The dealer model has a moderate risk as a local dealer is taxed on its profit. But if seen as a dependent agent, SIL may also be taxed. Overall, the choice of structured permanent establishment rule and tax treaty play a big role. Carefully planning is needed before entering the Sri Lankan market.
Right. So I want to know what is sales arrangement. That's what. Yeah. Whether they are liable for tax in Sri Lanka or not? Not liable. Why?
All the warehouse situation in India. All the warehouse also are in India.
That's the reason. It doesn't treat it as a source in Sri Lanka.
The custom in India. All the warehouse in India.
So other thing is, so under that tax obligation one. Obligation side only. Okay. One more. Yeah, that's right. Is it create a permanent establishment or not? Whether dealer model, whether there is a permanent establishment or not. අපි ජනයනා නැද්ද කියලා. There is no found in Sri Lanka. Confirm. Dealer model, there is no found in Sri Lanka. No. Sure. Okay. And so branch model. So then you have mentioned that what is this royalty and that type of thing. Yeah, go to India. Okay. Right. So fine, but under dealer model, basically it's whether there is an agency-based permanent establishment or not. Does it say the agency-based permanent establishment or not? Agent කෙනෙක් කරා නැද්ද? Dependent agent. ඒක තමයි permanent establishment එක create කරා නැද්ද කියලා අහුව එකයි. ඒක නෑ. ඔව් මෙන්න මේ වර්ඩ් එක ඒ වගේ එකක් කෝල් කරනවා මේ වර්ඩ් කියනවා the dealer will be prohibited from providing these services. Entirely he is doing that business one. That means he cannot do any other business. So dependent agent. Directly here in එක තමයි කියන්නේ දැන් අපිට මේ question එකේදී හරි practical එකකදී කියන්නේ මෙයා agent ද නැද්ද කියලා කියන you have to decide whether he is an agent. Yeah, he is an agent විදිහට යන මොකද he's employees ලා train කරනවා ඔක්කොම දේවල් දෙනවනේ technology එක දෙනවා know how එක දෙනවා. So that means it indirectly says he's the agent. Then we have to check whether he is a dependent agent or independent agent. Dependent agent. අර word එක ඒ වගේ එකක් highlight කරනවා. Right? So case එකකදී practically එකදී කෙනෙක් වාගාන ඇවිල්ලා මේ දීලා නම් ඔයා කියනවා if independent agent if not එහෙම බෑ whether there is a agency based PE create වෙනවාද නැත්නම් කියන එක confirm කරන්න confirm කරනවා tax impact එක කියන්නේ right මනලා කියන්න බෑ theory එක දැන් එහෙම කිව්වට හරියන්නේ නැහැ so in case of the what is this branch model royalty එක දීලා තියෙන්නේ royalty එක අඩු කරන්න බෑ මෙයාට what you mention is correct. It is prima facie permanent establishment create වෙනවාමයි. It is a branch. We need not to worry about the number of days they are doing business in Sri Lanka if there is a branch. But when they are work out profit, Article 7 knows again business profit they work out model. So these type of expenditure cannot be deducted. That's why you have to mention that whether that royalty and this other rent and all those things whether we can pay it or deduct or not. ඒක highlight කරනවා. ඒක කරේ නැහැ. Right? And the sales model. So in case of the non-resident person, he is selling goods to Sri Lanka. Even in sales model again. Right? So, but non-resident person, there is no source in Sri Lanka. That's why they are not liable. ඒක තමයි කියන්නේ. Other things are not liable. I mean, whether they do whatever thing they are, and nothing. They are non-resident person. Non-resident person are Lanka tax in but condition to be satisfied. They should have a source in Sri Lanka. Income should be generated from a source in Sri Lanka. The section 73 code there is no source in Sri Lanka. That's why they are not like. That import non-resident liable. Right? These points are very valid. I need tackle. Okay. Thank you. Anyway, the report is after you do the presentation with the comment and all those things. You have to work out the correct report and it should be submitted to the. Oh, why? Why? You have made other stuff because that's the exam.
So these are the two numbers in total. Such a quality, so it is that instead of Srilanka, registered under the company of the seven. It is such a planetary company based in Galle. Its ownership is divided among three parties. These are the three parties. After INC itself, UK-based company. And the provider INC it's also included in this company. It's also shareholder. And Amala, we are included in Sri Lanka. company in the catchment area of the contract. Currently, SHR faces financial strain due to a gearing ratio. Loss, payments and interest. So, to solve this, and various response to payment. And the second one is short term as well. Its shareholders including two UK companies transferring their shares to various arrangements. Their exhibit is which are letters. Our main focus is the tax exposure of the including shareholders under various sections. They are liabilities between Sri Lanka and England and 2017. But also Sri Lanka this analysis is exposure how it is to survive to capital gains, dividends, and business profit. Shareholders could be based on the structuring option. So, the main law is in the revenue tax of 2017. The law says residents pay tax on all income, but non-residents are pay on the money they earn in Sri Lanka. The two UK shareholders, Ryder Incorporated and Parker Incorporated, are non-residents. So they only pay tax on the money they earn in Sri Lanka. The two most important tax areas for them are dividend and capital gains. Dividends, which are payments from company profit, usually have withholding tax. Capital gain tax applies if there is a land, building, or shares in Sri Lanka company. In such cases, the seller has to pay tax. Since the companies are based in UK, they are still UK taxpayers, but Sri Lanka can also tax their Sri Lankan income. To avoid double taxation, both countries uses a tax treaty called the Double Tax Avoidance Agreement. In simple terms, this framework makes sure Sri Lanka can collect tax on local income, but also protect investors from being taxed twice. Also, the tax avoidance agreement. Here is tax treaty designed to make sure that their income is not taxed twice. It also divides the tax income reality between the foreign country and country. Under this treaty, there are several key categories. Dividends can be taxed in both countries, but Sri Lanka only applies the limited withholding tax with the balance taxed in the UK. Interest and royalties are treated in the same way, where Sri Lanka's tax rights are restricted. Business, the most relevant for our case is capital gain. If immovable property such as land and building is sold, Sri Lanka has the tax income. Normally, gain from shares are taxed in the UK. But if the values of those shares made comes from property in Sri Lanka, then Sri Lanka can also tax those. Relating to the Sunshine Housing Resort, we can identify two main options. Option 1, property transfer. Option 2, share transfer.
I presenting option 1. Option 1 means asset transfer. Lily Resource give the debts for the SHR company. So they have need to repay that. So there are more interest no interest and expenses, they can't do operations. So they decided, if they decided to sell their property and pay the debt to Lily Resorts, they have two different of tax exposure. One is company tax exposure. Company tax exposure is SHR company doesn't SHR companies, it sells the property and sells the property, they may gain the capital gain tax and other income tax, profit and income tax operating. So they have to sell it, they incur that tax. After that, shareholders are not cooperated in Sri Lanka. They are cooperated in UK, so they have not nothing pay for the tax. In case they are release the dividends, SHR companies if future gain the profit and dividends, they need to pay capital gain tax. That tax. Next one is exposure to the UK shareholders. Shareholders doesn't need to pay tax for their selling land or properties. So they have to keep their shares and ownership same as well. If they SHR release the shares, they definitely pay capital gains 14%. So Sri Lanka and UK have a agreement DTAA that the agreement shows they only pay 10%. The agreement given to them to that secretary. After that, the shareholders keep the ownership after the operations are on. I hand over to you.
It's just a change into own the shares, and the Indian government is provided and also they may have to pay capital gains tax in Sri Lanka. That's because the shares are considered to protect and villas which are over. Even though they are Sri Lanka is allowed to tax of pay. The UK might give them tax credits, so they don't pay for it. So in short, the SHR is paid, but the UK shareholders have tax to pay in Sri Lanka. It's smart to get tax advice before doing the deal. And over to already know the detail of these two strategies. Option 1, transfer, option 2, share transfer. So our final recommendation is to proceed with option 1, the credit transfer. Why we choose option 1 is because it allows Sunshine Holiday Resorts to continue its operation, maintain ownership of the business, reduce the cost, and minimize the overall impact on shareholders. Therefore, on both the financial and executive view, option 1 is the safer, efficient, and sustainable choice for Sunshine Holiday Resorts.
That's all. You are going option 1.
Yeah.
That is tax effective. Fact, financial management will talk about separately they are ideal company, so even though they are selling part of this, maybe good for them.
Yeah, continue the operation.
Yeah, ownership doesn't change. But so approach to that one. So one question: So you have mentioned that 14% tax. What is that?
40%. The shareholders, they take dividends.
Okay.
They give you the capital gain.
What is that? Capital gain and dividend tax. What is that? What are they?
Since a company future may incur the profit,
Okay.
they release the dividends.
Yeah.
Our shareholders, England corporated shareholders,
Yeah.
give it to capital gain tax in Sri Lanka.
Bring it. Okay. If the SHR pays dividend in future to UK shareholder, whether it is liable for capital gain tax.
With the dividends,
Dividend, capital gain tax. That's true. Only WST, right? What's the rate? What's the rate? Huh? 20. How the other voting? On dividend, with on what's the rate? Huh? What is the rate? Oh. Huh? 14? How the other voting in a dividend with on that rate? Here. Dividend with on that rate, Lanka here. 15%. Right, ETA rate apply කරන්න පුළුවන්. That's fine. So, other thing is, so under the second method, the first option, they are going to transfer land, right? Company. So, what is the tax exposure?
after the land,
Yeah. They need to sell the land and settle the loan. Yeah.
the tax exposure is if they incur the profit,
Yeah.
that corporate income tax they will pay.
Okay.
Another one,
Capital gain tax is right because it's a land, part asset, in a business asset, everything may be. Without a non-resident tax exposure here. That's your method, that's correct. And the second option, එතකොට පිළිවෙල ස්ටයිල් එක මෙයා එපා කරන්න හදන්නේ. එතකොට කාට හරි tax exposure because the whole purpose is to the tax liability of the non-resident person. ඒගොල්ලෝ තමයි අහන්නේ මේ. ඒගොල්ලෝ නෙවෙයි මේ අපි tax ගන්න ඕනද නැද්ද කියලා අහන්නේ. මම දන්නේ නැහැ. ඒක නම් අහන්නේ මම. බස් ස්ටෑන්ඩ් එකයි අහන්නේ. ලැබුණේ නැද්ද? කන්ෆර්ම් ගන්න බා ලැබුණේ නැහැ කියලා. Sure. Pretty sure. So no. The approach is here. It is selling shares. So yeah, sell කරන්නේ කාගේ shares? කවුද shares sell කරන්නේ? SHA එකේ shares
පාර්ට් කොම්පිටිෂන් එකයි
ප්‍රෝ රයිට් එක පාග් එක අන්‍යයන්ට ඊළඟට ඒගොල්ලෝ ෂෙයාර්ස් විකුණනවා. එතකොට ඒගොල්ලෝ සේල් ඔෆ් ෂෙයාර්ස් කියන්නේ investment asset එකක් විකුණනවා නේද? capital asset part of investment, so selling capital asset එකක් sell කරාම මොකද වෙන්නේ? investment asset realization gain is liable for capital gain tax. ආනය ලංකා රිසර්ච් කම්පැනි කොහොමද යා liable? අනිත් එක එතකොට තමයි රිෆර් කරන්න ඕනේ capital gain එක මොකටද? DT එක කියෝ වෙනවා liable වෙනවා කියලා කියන්නේ. liable වෙනවද නැද්ද? DT එක බලුවද? අතගෙන DT එක කියවද? ඇඩ්වර්ටයිස්මන්ට් වලින් ඇග්‍රීමන්ට් එක කියවද? නැහැ. සම්පූර්ණ කියවන්නේ. සම්පූර්ණ කරන්න නෑ රිලවන්ට් එක කියවල ඇත්තේ. දැන් කියවල බලලා නෑ ඒක. හා? බෑ මොනම බෑපතේ. right? So අතේක තමයි මම I am doing in good place, right? Because guys මේකයි මම මේ presentation එක මෙච්චර මේවා කරන්නේ. මේ වගේ ප්‍රශ්න තමයි අහන්නේ ඔයාගේ බෝඩ් එකක් හිටියොත්. ඔයා බෝඩ් එකකට ගිහලා ප්‍රසන්ට් කරනවා නම් යන්න නම් එපා වගේ පුස්තකයක්. ඔලුවට උඩින් ආවෙන විදිහ කරන්න. පුරු ගිහලා කියන්න එපා. ඒකයි මම කියන්නේ. right? So technical side you have anyway you have to improve. And other thing is presentation skill එක හදාගන්න ඕනේ. නැත්නම් මේ ඩිග්‍රී හදාලා වෙන මොනවා හරි කරන්න. පැෂන් එකක් කරන්න. beauty මොකක්ද එකක් දාගත්තා නම් හරි. මේ බුදු පාඩ කර කර හිටියයි. That's what I'm doing. So if you are in this field, you have to, these are the things, right? Then බලන්න කලින් presentation දෙක තුනක් කරා හොඳට කරා. I'm very happy on that. So ඒක එකක්. දෙක තමයි බොරුවක් කිව්වොත් ඒක තමන් දැනගන්න ඕන depend කරන්නේ. There should be a ground. Right? ඒ skill එක තමයි I'm testing. Right? මෙතන ගිය පාර batch එකේ කෙනෙක් ඇවිල්ලා challenge කරා මාත් එක්ක. නෑ වෙන්නේ මෙහෙමයි. පොරුක පස්සබල් බෝල් කියන්නේ මම මාත් එක්ක that should be some sort of ground, right? So ඒක ඊළඟට අර මේ if කියන එක use කරන්න එපා. ඔයා advice එකක් දෙනවා නම් හරි answer එකක් දෙනවා නම් if this is satisfied this is කියන එක කියන්න එපා. Because facts and ඔක්කොම දීලා තියෙනකොට you cannot say that. if somebody is මම ඇහිලා අහනවා කියන්නේ ඔයාගෙන් මම මේකට tax කියන්න ඕනද නැද්ද? ඔයා going if this thing are yes, this thing are yes, that is not. Remember, you have to analyze and give the answer. Right? මේකේ UK DTA එකේ taxing right එක UK වලට යනවා capital gain එක. ලංකාවට taxing right නැහැ. ආයි කියලා බලන්න. එතකොට pro right එක්කෙන අර shares dispose කරා ලංකාවේ. We don't have taxing right. අපිට කියලා බලන්න ඒකේ තියෙනවා condition දෙකක් යට. ඒක satisfy වෙනවා මේ case එකේ. මේක මේ ඇත්තම case එකක් ඔයගොල්ලන්ට දුන්නා. ඔය මන් දීපු කේස් හැම එකම ඇත්තම කේස්. බොරු ඒවා නෙමෙයි. really වෙනේවා. right? මේ දැන් වටපිටාවේ වෙන දේවල් තමයි තියෙන්නේ. ඔය ඔයාලට මම සමහරවට මම ඔපිනියන් දෙපේ. මේකේ මේ කේස් එකේ ඔපිනියන් එක කලින් කියලා දෙන්න වැඩි ඒක මට කතා කරා. අල්ලීලා දුන්නා මම ගත්ත සල්ලි. And the guy is very happy because the wife is okay and he has tax again. Tax ගන්න කලින් තමයි මට කතා කරන්න දෙලා. මම no that is as per the Sri Lanka domestic law here. Liable. But as because DT එකක් තියෙනවා. බැලුවම beneficial loan වෙනවා. ඒ condition ටික satisfy වෙනවා. Satisfy වෙනවා නා taxing right goes to UK. We don't have taxing right. Right, okay. improve කරගන්නේ තරහට නෙමෙයි මම කියන්නේ right ඔයගොල්ලන්ට exam එක පාස් වෙන්න පුළුවන් exam කරන්න පුළුවන් හැම වෙලාවෙම දැන් this is the last chance आपने ऐसे का तो
Dr. Land is Dr. Dr. Lilies was common and
ओके ग्राफ लोड
एक small thing better.
नहीं तो एक हालत में लेना है वन फिर छाड़िए दें Okay. Up. Up.
Finance. Okay. That make it.
$25. Finance perspective. Support karo. Right? All feedback. Fine.
Taxation of employee payments to government of Sri Lanka, taxation of employees business in Sri Lanka, the taxation. So, some presented recommendation, in the company, permanent establishment of yes, they have to all then I even done the electrics. And the taxation of income categories, recommendations and regulations. Then it's pretty done. So they will see the option. The original start is that a company is cooperative in margin. So we specialized in safety. Oil research, there is a exploration in the analysis. So, particular activity, the ocean extract is responsible for having our exploration part. This is preparing a video report for potential of oil in this environment. So, for this year, ocean extract received an agreement of $200, 200 million. So, the once the explanation is completed, the responsibility shifts to the Lanka. So, they set up the oil rate, extract the oil, and supply it to refinery Sri Lanka. So, for that, the Lanka has to pay a royalty fee for the Sri Lankan government of natural. So, the key feature of this arrangement is that the ocean extract has station a vessel in Sri Lanka. So, in territory water, where employees will be looking to work so for a 2-year contract. So, detail is very important. So, there because the question is whether the ocean extract has created what is known as a permanent establishment in Sri Lanka. So, the main purpose of a report is to evaluate whether Sri Lankan has the right to tax ocean extract income under the local tax laws. So, tax laws and the double tax about the agreement. So, the policy taxation shows analysis considered several aspects. The recognition of a permanent taxation and the categorization of income and the application of the unit of 2017. So, I hand over to
statement. How to handle the draft. Then they are available in Sri Lanka. The actor also following an individual meeting. Holding tariff on evidence, interest, and loyalty. Yeah. Articles areas such as witness, mostly one part
Establishment is defined under Sri Lankan law and how it applies in case of ocean extract that carried out all oil exploration in Sri Lanka under Sri Lankan Act number 24 2010 of Sri Lanka. A permanent establishment exists when a non-resident maintain a place of business in Sri Lanka. Permanent establishment may also arise if substantial equipment is used within the country or if services are provided for a period exceeding 183 days. Similarly, under the Sri Lankan Income Double Taxation Avoidance Agreement, Article 5 defines permanent establishment as a fixed place of business such as an office, factory, mine, or oil gas as well. In applying this provision to express limited, the company has visually substantial equipment creation in Sri Lanka water for a continuous period in two years within two employees residing on site throughout the contract. This clearly satisfies the permanent establishment threshold as it is exceed both the 90 requirement under the Inland Revenue Act and 6-month requirement under the Publication. If the activity was oil exploration, it is classified as resource exploration. It's the base salary within a limited permanent establishment. Or also extract limited is registered as continuous permanent establishment in Sri Lanka. The profit attribute to the permanent establishment are taxable in Sri Lanka. So as the corporate an enterprise will be treated the same way as independent local business, Sri Lanka has primary right to tax this profit, while Denmark will grant a tax credit to eliminate the risk of double taxation or to
the taxation implication for offshore extract limited under the Sri Lankan Denmark BSAA. First, this agreement fee, USD 200 billion. The $200 billion fee paid by Sipetco Lanka to Ocean Extract Limited is the key issue in here. Under Sri Lankan tax law, this payment can be taxed as a business profit if it is conducted permanent establishment in Sri Lanka. If there is no permanent establishment, taxes profit are only taxes in Denmark. But in this case, Ocean Extract Limited has a vessel and employees working in Sri Lankan quarters over 2 years. So this clearly creates a permanent establishment. Therefore, the 200 billion fee is taxable in Sri Lanka at the corporate rate after deducting expenses related to permanent establishment under Sri Lankan Inland Revenue Act. And royalties payable by Sipetco Limited to the government of Sri Lanka. The royalties paid to the Sri Lankan government are not income for the Ocean Extract. There are simply legal obligation of Sipetco Lanka for using Sri Lankan natural resources. And since Ocean Extract does not receive this royalty, they don't create any tax explore for the company. Let's talk about the tax treatment summary. The 200 million USD dollar fee is taxable in Sri Lanka as a business profit. The royalties paid to the government are not Ocean Extract income, so they are not relevant for its tax portion.
I'm going to discuss about the double tax relief and the conclusion part. So, when we discuss about the double taxation relief, Ocean Extract is still a Danish company. So, Denmark will also want to claim the international income tax. But in this case, Denmark also try to claim the tax. That means their Ocean Extract might be a double tax. So, according to the agreement that Denmark and Sweden has gazetted on under Gazette number 228 in 1983 January, says that Sri Lankan has a primary right to tax because of the business profit linked to a permanent establishment in Sri Lanka. So, Denmark will provide a relief or tax credit while doing a Denmark tax arrangement. So the company won't pay twice under double tax BSAA in accordance to the double taxation relief agreement in Sri Lanka and Denmark. When it comes into the recommendation, since Ocean Extract Limited allocating expenses accurately and maintain a clear records in their operation in Sri Lanka and utilize the BSAA benefit to leverage the claim for foreign tax credit in Denmark, ensuring a global tax efficiency as well. When it comes into conclusion, our goal is to find whether the 200 million USD paid by Sipetco Lanka to Ocean Extract, whether taxable in Sri Lanka or Denmark. So, according to the double tax agreement between Sri Lanka and Denmark, it's a permanent establishment company in Sri Lanka. They have a business in Sri Lankan water and they have employees working around more than 2 years. So, after our research, we realized that this income is utilized under Sri Lankan Inland Revenue Department taxable, and about the Ocean Extract is not payable into the Denmark taxes.
Right. So, fine. As per this one, so that Danish company, they have vessel in Sri Lanka water. So definitely, as per the Article 5, Para 2 is the permanent establishment. We need not worry about how many days they are in Sri Lanka. That's the triggering point. Based on this guy, in case of the non-resident person, we see whether we can tax them. As per the domestic law, irrespective of whether they have a permanent establishment or not, when we are making a payment, service payment, just like this type of thing, we are deducting tax. Right? But triggering a fee is important. Once we trigger a fee, so then we have the taxing right on the total business income. The first instance, there is no fee when we are making the payment. At that point, we are deducting the total tax only. Right? So that is the main point to enter. So other thing is that payment of the royalty to Sri Lanka government. That is, Sri Lanka resident company pays the royalty to government. This is subject to withholding tax. Kaya tu kata, kalau kita lagi, saya benar. Nah, gua nanti lagi masa ini paper ya. Saya benar ada. Dipastikan. Hah? Udah ada. Alam ni lah. Saya benar. Government air began order with one and a cannot be considered as a person. ඒක තමයි hiding point එක එයා මේකේ එකක්. right අනිත් එක තමයි අර ඩැනිෂ් කම්පැනි එකේ අරගොල්ලෝ කොච්චර කාලෙ හිටියත් නැද්ද දෙකයි. ඔය මේ අර මේ කේස් එක ඔය තියෙන්නේ. කලින් ඔය එක්ස්ට්‍රැක්ෂන් එක කරන්න ආවේ. ලංකාවේ එක්ස්ට්‍රැක්ෂන් එක කරා අය වගේ. right ඒ කේස් එකක් ඔය තියෙන්නේ. right so anyway so because they have අරකේ නෑ number of days is not material. ඒතකොට අර number of days අපි බලන්නේ they cannot figure there is a fixed business location in Sri Lanka. Then branch office there is a tangible place. We can see visible place. That's why I say it's the permanent establishment. Number of days count කරන්නේ එහෙම place එකක් නැහැ. There is no location. We cannot find a location. Somebody can come and do that consultation and go back. Come and do consultation and go back. So the number of days count කරනවා. Count කරලා බලනවා මේ trigger වෙනවා. Clear? Right. එතකොට මෙයාගේ permanent establishment උනාට පස්සේ මෙයා employees like cost එක vessel එක ගෙනල්ලා තියෙනවා නම් ඒකට capital allowance උත් ගන්න පුළුවන් බෑද? That point need to be at. Right. Apart from that, when they are remitting their profit back after paying that, income tax තියනවා කියලාත් බලන්න. Okay? ඒවා ඩොක් කරලා නැහැ. So don't throw away that theory thing. Case එක දුන්නා practically theory එකට apply කරන්න. Theory එක apply කරන්න මේ case එක. කියන්නේ company දීලා තියෙන මේ company අර company ඒ company වල නෑ either non-resident. එහෙම නෑනේ අපිට. දැන් කලින් company එකේ කිව්වේ මොනවද financial implication නෑ. Financial implication නෙවෙයි අපි කතා කරන්නේ tax implication. story එකක් දීලා තියෙනවා. ඒ අදාළ එකට දාන්නවා. Right. Okay. Oh, 1000 ඔයගොල්ලෝද? අර මතනේ බයි. දැන් නෑ විශ්ල. යන්නේ. අපේ මොකද group එක? Steve Morgan. දැන් ඩවුන්ලෝඩ් කරලා දෙන්න ඕනේ ටික. ඇයි මේකට දැම්මේ නැද්ද? LM දැම්මේ නැද්ද?
About implication of just movement. Yes, let me introduce for introduction. Justin Morgan Incorporated is a Canadian company and they are opening a branch in Sri Lanka. They provide migration and consulting services. They
their aim is meet local demand and strengthen global presence. Sri Lankan operation subject to International Act number 24 2017 and Sri Lanka and the double taxation agreement. President first, first we need to take companies registered in Sri Lanka. First, we come with they have registered incorporated locally or effective management in Sri Lanka. Case just incorporation is incorporated and managed in Canada and non-residents from Sri Lanka tax purpose and non-residents tax only on Sri Lanka source income. Permanent establishment regarding to the Sri Lanka and Canada BSAA, this company have branch in Sri Lanka. This company is liable to the taxation. Next.
Now, if we can see how the Sri Lankan law applicable to the application of the companies, then if the company have Sri Lankan source income, then the company should be paid tax, and the exemption can be deducted into the profit. So income reduction of income. So exemption can be deducted into the profit. And the management consultants fee, the consultancy fee, it should be based on the arm's length price.
Canada. So the purpose of this BSAA is to avoid double taxation, allocate tax rating, right? And also promote to procure trade and investment. According to Article 7, maximum is providing the profit. Enterprise income is only taxable in home states, but exception is there if the corporation is conducting through a permanent establishment. Then there will be taxing in other countries as well. In the case of just Morgan Corporation, they have a permanent Sri Lanka. When it comes to Article 12, fees and technical services, withholding tax applies if the consultancy which the Canada, their parent company, providing is technical services. But the tax rate is lower than the domestic tax rate. But if this transaction is treated as a intergroup it can be covered under Article 7 as well. When it comes to Article 23, which is regarding relief from double taxation, Canada grants a foreign tax credit to Sri Lankan who pays tax in Sri Lanka to ensure fairness and prevent double tax being given to organizations.
See how the double taxation agreement applies to this company. After completing the since this is a permanent establishment, this company should be paid tax. Each company should be paid at the appropriate rate. 10% is a tax rate, and the management fee of the company. Management fee, there's a 10% management fee. That management fee should be arm's length price. And if it is not the arm's length price, IRD can decline that fee, and if the company is reinvest in profit, the investment profit is not taxed, and they can be qualified for investment incentives. Then after the company is involved can claim foreign tax credit on Canada as per the BTA agreement. and the withholding tax applied for this bodies and sectors.
How we can do the tax planning and compliance. Actually, the management fee for the pay, we have to make a fair basis, and it should be in a arm's length transaction, and also it should be properly documented. And corporate tax compliance, we need to file all the return on time in order to not against the penalty. And the implication of profit sending from to Canada may sometimes it can be cost, so we can have strategic planning in order to reinvest on these profits. And tax incentives, incentives and allowances will be invested in infrastructure or technology within the Sri Lanka. Maybe we will be able to qualify some tax payments. So, and also the risk management. So we have to think about reputation and further load in on regarding.
Expenses can be, they are directly linked to third income and issue is management consulting. The Canadian head office charge high consulting fee, which reduced by about 30%. This fee was allowed from the pricing changes. They should be fair and market. Others, there are also rules on capitalization and related part transaction. Charge needs strong documentation to support and define these expenses.
Questions? No. Again. Right. So, no, because this is there is definitely the branch of it. It's a permanent establishment. So when they are making the payments, just like say royalty and all those things, they are seeking whether they can pay to the can they pay 30% tax on your management fee. Yes. Can they pay?
The outstanding transaction and
So what you have mentioned that 30% rate, what is that?
is corporate tax rate. Subject to be paid tax in corporate tax rate.
So that means the branch profit.
Yes.
Because Canada Sri Lanka DTA is little different. We say that whether that there is no restriction under Article 7 to pay off the management fee royalty, whereas in other agreements is there, just like say India, China. So that agreement says that this type of things cannot be paid. It's not, yeah, I mean, it's not a deductible expenditure. So that is the point I have discussed in this case. Fine. Fine. Follow thanks. After that. Kita tambah lagi dah. എവിടെയാണ് ഇവിടെ? Five. Five. We can start. That you can start.
Good afternoon, everyone. We are number 7. We are presenting here the exposure of global limited in Sri Lanka. These are our contents. We are going to introduction. TMT incorporated in the Philippines, in Sri Lanka, we are subsidiary Global Electronics Lanka, which manufactures and distributes electronics. GMT also has a branch in India. GL made payments for healthcare, 500 million for GMT Indian branch. Later reimbursed the amount. This raises question about taxable income and possible permanent establishment in Sri Lanka. So objectives of the scenario. Evaluate the tax implication of cross-border reimbursement by GL for GMT and assess relevant tax exposure. This one is tax residency and liability. Checking if GMT is resident or non-resident and if healthcare 500 million reimbursement is taxable. Next one is permanent establishment. Determine if global electro payment facilitation creates a permanent establishment and review double taxation avoidance agreement effect. Next one is income categorization. Classify reimbursement like business profit such as service fees or other ends determine tax free right. Next, withholding taxation transfer pricing. Establish obligation and ensure arm's length compliance. Next, the scope of the scenario, domestic law. When it comes to Sri Lanka, Inland Revenue Act 2017, tax residency, permanent established rules, profit attribution, and cross-border payments, and WTN transfer pricing. International treaty laws, Sri Lanka, Philippines, the agreement. Article 5 says permanent establishment and dependent agent. Next one is Article 7, business profit attribution, and Article 23, double taxation relief, and international standard principle, organization for economic cooperation and development, United Nations conventions, first permanent establishment definition, arm's length principle, profit allocation, and OECD transfer pricing guidelines for recommendation and compliance. It's a hand over to this one.
Yeah, I will be explaining about the transaction overview of so there's a Philippine parent GMT and then a Sri Lankan subsidiary PL and also an Indian branch. So the transaction what gets happened as previously mentioned is a payment of 500 million on behalf of GMT India branch by SCL, which is the Sri Lankan subsidiary. So what has happened is a reimbursement without any markup. So it's only a cost which has been prepaid again. So we will be looking at the tax implication regarding the WHT, the tax company tax, and whether it has been paid in markup or with the profit. So regarding the tax residency and permanent residency, so as you all know, the tax residency will come, the organization is taken place in Sri Lanka, situated, or the majority of effective management, which is also called the POEM, is in Sri Lanka. So then it will take place. So when it comes to GMT, which is between incorporated, so there will be no things which will be happening in Sri Lanka, so transaction in Sri Lanka. In terms of GEL, it's a Sri Lankan entity, it has to be taxed according to the Sri Lankan revenue laws. So permanent establishment the definition. Cash flow is based on a business, that it can be office, factory or anything. And also the contractual obligations, dependent agent have to conclude a contract. And also any construction project with more than 6 months, that can be also called as a permanent establishment. So the application related to GMT, GEL didn't have any case laws or only made the facilitated payment. So it cannot come as a permanent resident. So the based on the OECD guidelines and case law, GEL so doesn't create any permanent establishment in Sri Lanka.
Now let's look at income characterization. First one, rate of the reinvestment. Here, GEL company, this is Sri Lankan company. Rate operational expenses for GEL is Indian dollar. It is the parent company, Philippine parent company is Indian dollar, and they didn't make any profit. Instead, they claim they reimburse the cost. So there's no markup, and according to the Sri Lankan tax law, no tax is allowed. And the next one is under the DTA agreement between Sri Lanka and Philippines. Only the resident companies who are the permanent establishment, the companies that are permanently established in Sri Lanka only applicable for tax in according to Sri Lankan law. So in here, GMP is not the permanent establishment in Sri Lanka. So reimbursement is outside Sri Lanka's taxing right. And next one is if IRD classifies the 500 million expense for the Indian branch of GMP. If they classifies this as a service income instead of a reimbursement cost, then it will be taxable in Sri Lankan law. But according to the scenario, the GEL does not make any profit. So with the DT agreement, this offers relief for the company. Of the arm's length principle, the GEL must maintain proper documents to claim the reimbursement, and there is no profit. And the actual cost is claimed. And the next one is WHT risk. If GEL offers a service to a non-resident, it will taxable 10% to 14% WHT according to the tax law. But if they show proper documents and DTA agreements, they can get the exemption. The next one is the risk mitigation. They could maintain intercompany agreements and proof of expenses and repayments without markups, and consider advance ruling from invaluable if needed.
The investment details of the daily scenario, the scenario is reimbursement recovery. If the level of risk is low, the return is not permanent establishment because they are now fixed rate in Sri Lanka. So the past and the past low. The second scenario is reimbursement reach to pay at the level of risk is moderate level. And the return is possible for interest and country detail. The scenario is transfer pricing. The level of risk is low to moderate. The definition reserve DEL to maintain arm's length guidance and looking for the
internal documents. Not generally dependent anything. Therefore, it's independent of the arrangement, not there in the GMP. Create a recommendation to reduce taxes. You should follow the total state. Guess what is the full document. The payment agreement must have information roles and follow the payment. So it is a unique statement and not then from the second one is use formal agreements. Here, company agreements must the electronic Lanka only make payments on behalf of GMT and did not provide any tax. That one is applying the tax treaty. Final tax residency certificate from the Philippines to use DTA benefits and avoid unnecessary reporting tax in Sri Lanka. What one is transfer pricing report. Keep a transfer pricing report to prove the payment of at arm's length with no profit elements. Based on our study, local medical printer visa, non-resident in Sri Lanka, Sri Lanka cannot tax any. And the 500 million is only a cost plus use income. There is no correlation period by this transaction. And risk of transfer pricing for withholding tax are very low if proper documentation is intact. Therefore, with the right compliance measure, GMC can avoid unnecessary tax exposure in Sri Lanka and continue operations.
Okay. Right. No. Percentage is wrong. Right. First thing is, so the why what is the intention of this assignment? To test the liability tax. Taxable non-resident person. GMT is a company incorporated in Philippines. So they want to make a payment to India branch of AA, but they have a subsidiary in Sri Lanka. The subsidiary is making the payment to India branch. So as per section 73, if any service fee payment made from Sri Lanka, it shall be treated as a source in Sri Lanka. Right? So whose payment is their Sri Lankan subsidiary is making? The non-resident person's payment, service fee payment are paid. Right? So there is a source in Sri Lanka. But having said that, if it is a reimbursement of expenses of a non-resident persons outside the environment outside Sri Lanka, then it is not treated as a source in Sri Lanka. That is the first point. Right? 73, subsection 1C clearly mentioned that if that payment is, even though it is a service fee payment, but it is a really reimbursement of a non-resident person's expenses which is connected to the permanent establishment outside Sri Lanka. So GMT is a non-resident person. They have a branch office outside Sri Lanka. It's a non-resident person's permanent establishment outside Sri Lanka. On behalf of that Sri Lankan person, make the payment. Therefore, it shall not be considered as a source in Sri Lanka. Right? Under that category, they are not liable for tax. Second thing, so other point here is they are asking that they have a subsidiary in Sri Lanka. Just because of a subsidiary parent relationship, it doesn't create a permanent establishment. That's the main point too that need to be added. Right? It has not been added. Right? So, you have no reporting. Okay. So, I give sources Sri Lanka. Yeah. And can I help? That's nice. You? Okay. Okay. So you did the tournament? Group 8, right?
The income managed by calculating and basically financial for the tax liability, the and the compliance obligation, and the income for the conclusion and the recommendations. Government or DDAA. It's important to prevent taxpayers from being taxed on the same income and California taxing wise with the countries. So in our case, Dr. Jonathan Blake is a retired medical professional, which is from the UK, who has temporarily relocated to Sri Lanka for 1 year. So the analysis mainly focus on our domestic Sri Lankan law, which is Inland Revenue Act of 2017, along with the Sri Lanka and the UK DDAA to determine his tax liability. So let me briefly outline the key facts. Based on the nature of income and transaction, Dr. Blake earns income from freelance medical consulting in Sri Lanka, and also he continues to receive his UK government pension, and also he considering selling a residential property in the UK during the year. And this year, from him, he planned to reinvest in Sri Lanka through a foreign currency banking direct account and also listed securities in the Colombo Stock Exchange. So, in based on residency consideration, since he stays in Sri Lanka more than 183 days, he may qualify as a tax resident under Sri Lankan law. But however, residency rules and the provisions of the DTAA are crucial to determine whether Sri Lanka can tax his worldwide income or only the income source within the country. So, over to Mike. This status is established for 183 days or more. For example, Dr. Blake has 1 year of consumer presence in Sri Lanka. He may qualify to be tax resident and his price. And section 8425. The post tax and equivalent trade and paid to non-resident. Dr. Blake, resident tax relator, he pays on tax on his income according to the property personal income tax rate. Under section 3, both local and foreign taxation from outside Sri Lanka and separate unless specifically exempt by under the law.
While Dr. Grace British government pension to be subject to cap under unrevenue act. In fact, is applicable on the sale of assets situated in Sri Lanka. In here, one thing gains from Sri Lanka and global company. Sri Lanka double tax origin they define resident as a person who is liable for tax by the result of dominating tiebreaker family educated habitual about than nationality. Article 4 is tax only the resident state unless it's based in other state. Article 39 includes pensions, UK government pension, taxable in UK. And Article 30, capital gains, UK property sales, taxable only in UK. Sri Lanka cannot be taxed. Dividends and interest. Article 21 for tax rate. Double taxation. Separation analysis. Sri Lanka can have different non-resident countries and this slide is about the income analysis by definition. Next one is finance legal transaction. Legal income is provisional income from independent personal services. Sri Lankan tax statement is under the Inner Revenue Act number 24 of 2017. The income derived from services rendered in Sri Lanka is considered Sri Lanka's sources income and is taxable in Sri Lanka in residence. Since Dr. Ray is physical present and rendering medical consultancy in Sri Lanka, this income is taxable in Sri Lanka. BTA application is article number 40, independent personal services. BTA between UK and Sri Lanka. Income from provisional services is taxable in the country where services are performed unless there is no fixed base in the country. Since Dr. Ray is staying for 1 year and consulting government of Sri Lanka has taken the right. The government measure of income is post-retirement pension from UK government. Sri Lankan tax treatment is normally pensions received in or retirement to Sri Lanka by a resident individual will be taxed under the Indian Revenue Act. However, we must examine the DTA provisions, and DTA application is article number 8 is government functions. Government functions are taxable only in Sri Lanka. Pensions are taxable only in the UK unless the district in the Sri Lankan national and the Dr. Ray is not. Next one is capital gain from UK property. Nature of income is capital gain from disposal of immovable property in UK. Sri Lanka tax treatment is under Sri Lanka's Inner Revenue Act. Capital gains are taxable only if the property is situated in Sri Lanka and foreign
immovable property gains are not Sri Lanka sources, so they are not taxable in Sri Lanka. The DG application is article number 30, capital gain, DG between UK and Sri Lanka. Capital gains from immovable property are taxable in the country where the property is located. Hence, UK has exclusive taxable right. Conclusion is taxable only in UK. What is Colombo? Nature of income is dividend and capital gains from listed securities. And Sri Lanka tax treatment is under there are two. First one is dividends and capital gain from listed shares. And DG application is the article number 10. It's the dividend. And it is from UK and Sri Lanka. Sri Lanka to tax dividend by general trade. However, Sri Lanka already said dividend in the index. Under the Indian Federal Act number 24 of 2017, the percentage that spends more than 103 days for more than is considered as a resident. So, the resident is taxable in worldwide income. Is taxable only on Sri Lankan income. More than 183 days and he is taxes. He is liable for his income. The double tax avoidance activity in Sri Lanka and UK is for double tax program. So, Sri Lanka is federal factor. Amount of money taxpayer is permitted to reduce from the income tax liability. That he liable to the government. Is the great in this case, he has the income from both Sri Lanka and UK. So, Sri Lanka is paying tax in Mr. Blake is liable for the medical consulting income as it is a Sri Lanka source income and under the domestic law and financial policy. And the UK government pension is taxable only in UK. It is under according to the Article 7. And capital gain from property it is an involved property in the UK. So this is taxes in only the UK as it is located in the UK. It's in the Colombo Stock Exchange and also the deposition in the account. So these are exempt as they encourage investment by avoiding these exceptions. That's what it is. The first one is as a tax liable person, with the IRD and obtain a identification after. And the next one is the resident for a non-resident in Sri Lanka income. He must file the annual tax return, including all his income tax, the claim expenses. The next one is withholding tax. Payments from Sri Lanka such as the hospital paycheck, the final tax, and also the players can also against his annual liability. The last one is the completing proper documentation is a must with the verification of UK tax
most of that is basic to his tax in UK and Sri.
So Dr. Blake's case highlights the importance of residency status and the Sri Lanka UK DTAA in determining the tax liability. So his freelance consulting income is taxable in Sri Lanka. So while his UK government pension and capital gains from UK property remain taxable only in the UK, as per investments in FCPU agencies and the Colombo Stock Exchange provide favorable tax treatment, and overall Sri Lanka's tax system is effective in preventing double taxation but faces challenges in efficiency, fairness and the compliance. So when we talk about the recommendations, Sri Lanka should strengthen tax administration with modern systems and broadens the tax base and reform the policies to encourage compliance and enhancing transparency, updating legal frameworks, and ensuring the fairness and sustainability, which will help to build a more credible and growth-oriented tax system.
Right. So, fine. Okay. ඔයාලට ඔගොල්ලෝ residential status එක හරියට කිව්වා. Whether he is a resident or non-resident. So if it's a resident, so then DTA is not applicable. Right? And on that point, you have to analyze that whether they are liable for capital gain tax. Of course, your pension and all those things, what you have mentioned is correct. But other part, that 2 points that need to be clearly mentioned in the report. How many?
Hi, good evening everyone. We are group number 9 and we are here to present taxation analysis of Niva Construction Services Limited in Sri Lanka. This is our group, this row. I will be present introduction and Dinura will be present case background. Sahan will be present PE analysis. Bilan will be present tax liability of NCSL employees and consultants. Yasiru will be present obligation to LTP. Tanushka will be present DTAA application. Then move on to introduction. This case study is about the service agreement between Niva Construction Services from Belarus and Little Venice from Sri Lanka. Niva provides architecture, engineering, and design services for a large project in Colombo. The contract runs for 7 months. With Niva staff work in Sri Lanka while payments are managed from Belarus. The key focus is on tax compliance. We need to see if Niva creates a permanent establishment in Sri Lanka and how the income should be taxed. This also includes checking the withholding tax duties of Little Venice. The assessment is done under the Inland Revenue Act of 2017 and the tax treaty between Sri Lanka and Belarus, which help to avoid double taxation. Over to Dilbert.
So when speaking about the case background, NCL has entered in 7 months contract with to deliver comprehensive architecture and engineering services valued at euro 1.525 billion. To meet the project objectives, two specialist teams were deployed to Sri Lanka because the first comprised 5 senior employees and stationed 4 months to carry soil testing, soil inspection, and technical data collection. The second team includes 2 external consultants who prepare architectural plans and spend 3 months supervising construction to ensure the design were correctly implemented. From a financial perspective, NCL's cost covered consultancy fees, employee remuneration, and purchase of computer equipment with professional payment transfer to Belarusian bank account.
Let's talk about the permanent establishment. As you all know, permanent establishment in Sri Lanka handled by the Inland Revenue Department under Act number 24, 2017. So, when determining the non-resident entity becomes liable to tax in Sri Lanka, that's the permanent establishment. So, they have conducted any business activities in Sri Lanka more than 183 days, they are liable to pay taxes in Sri Lanka. In here, they have main business activities perform soil testing, inspection, and supervision. So they are mainly established to the under fee. Let's talk about the presence of NCSA. They have been in Sri Lanka for 7 months. So, as per the BSAA Act number 5, there will be a permanent establishment if they have been here for more than 6 months. So, as per the case study, they have been here for 7 months and they are liable to pay. So, over to Pilar.
So let me take you through the tax liability of the employees, consultants, and corporate fees. Here, the employees work in Sri Lanka for 4 months. Since their work was physically carried out here, Sri Lanka treats their income as Sri Lanka source under the DTA because they stayed for more than 183 days, and their salary are therefore subjected to personal income tax under pay. So when it comes to consultants, there are 2 external professional consultants according to our case study. So here the consultants fall under the independent personal services. They spend 3 months in Sri Lanka and operates from the fixed base provided by the project. That gives Sri Lanka the right to tax their consultancy fee, which is generally taxed at a 24% flat rate for non-residents. And also, let me take you through how the tax available deductions and net tax income and withholding. According to our case study, the available deductions are when it comes to the salaries of the employees, it's euro 300,000, and then consultancy fee is 160, and there is also depreciation of 24,000 euro. Then the total revenue of the project was 1.5 million euro, and after the available deductions are done, almost it's 400,000 plus deduction. Then the taxable profit it comes to 1 million. Then after that, applying the 30% corporate tax gives a liability of around 300,000 euros. So when it comes to the withholding tax on
On top of that, Little Venice Limited, the local company must apply 14% withholding on payments to NCSA unless reduced under the DTA. Employees pay on their salaries, which while consultants are subjected to withholding for 14 to 24%. So finally, any taxes paid in Sri Lanka can be claimed as credit in values under the DTA, ensuring there are no doubt taxation. Then after that, for the obligation and legal menace.
So, obligation of legal menace private limited. They are liable to directly withholding tax with on the their service fee. And next is tax clearance certificate. They must obtain it from the IRT before they send it to council finance. And they should keep recording and certificates where responsible for issuing withholding tax certificates and maintain detailed records to ensure compliance and transparency. Next is DTA and evaluation responsibility. How do you? Let's talk about the DTA and evaluation responsibility. DTA purpose one is for DTA between Sri Lankan and Belarus prevent double taxation and defines permanent establishment. Criteria for fair taxation. Role of in IRD. IRD evaluates PE status and classifies income and applies DTA provisions and issues the tax clearance certificates. And next is tax relief. DTA enables tax relief to the exemption of foreign tax credit to minimize double taxation and let's overview the Sri Lankan and Belarus DTA and key questions. First one is tax covered. In the Sri Lankan side, corporate tax, employment tax, and the withholding tax in Sri Lanka, and profit and income tax in Belarus, and residence rules. Tax residence based on the dominical land incorporation and management, permanent establishments, PE, private and service extended 180 days NCL qualifies, and income allocation, profit and employment income tax in the Sri Lanka is linked to PE. Next one is tax exposure to expose and the relief mechanism. Double tax relief. Double tax relief is one method, the credit method. Credit method for the Belarus offset Sri Lankan taxes against the domestic liability. For example, consultants pay euro 20,000 in Sri Lanka. Only 5,000 payable in Belarus. If total due to the euro 25,000. And tax exposure breakdown. NCSA, liable for corporate tax in Sri Lanka, must then maintain records. Employees to consultants. Income taxable in Sri Lanka, eligible to foreign tax credit in Belarus and LVN. Must withholding tax on the payments to NCL and personnel. Non-compliance with penalties. And recommendation for NCSA. For NCSA, register for corporate tax in Sri Lanka, maintain detailed records in service and duration Belarus, ensure compliance with permanent establishment and establishment rules, and PE annual tax return and get process for income. For the employer person, declare Sri Lankan source of income in Belarus and claim foreign credit to avoid double taxation. Key documentation of tax paid in Sri Lanka. Next one is LVL, withholding tax to payment to NCL and other personnel, maintaining payment records to tax filing, and coordinate with NCL to ensure proper documentation. And general advice. General advice seek professional tax guides in the both distribution and monitor service during the avoid fee setup and the use DTA provision to maximum tax exposure and the legal risk. Okay. Next on this conclusion. The conclusion for the engagement between NCL and L will create the permanent establishment in Sri Lanka due to the continuous on-site presence are used to the infrastructure. As the result, the NCL is liable to pay corporate income tax in Sri Lanka on profit attributed to this fee. The salaries of employee and fee of the consultant are considered Sri Lanka, so income and therefore taxable locally. To the foreign tax credits may be claimed to Belarus under the DTA, LVL manual. It is responsible for withholding and remitting tax on the payment to NCS and the issuing tax certificate. Overall, the case highlights the importance of proper PE assessment, tax compliance, and the effective application of the DTU to mitigate double taxation is cross-border service agreement. Thank you.
Right. Guys, in the two things. So in this case, so what is my testable area? How to create a permanent establishment? They are sending their employee, and they are sending their consultant. Consultant means they are not their employee. But even though that is what the say consultant or person or other person, employee or other person. Overall 6 months, that's fine. So there is permanent establishment, and there is a project going on. So we have a project, right? So then, on that condition, we are creating a permanent establishment. They are liable for Sri Lanka tax. That's fine. So a point is highlight, right? A point highlight. So our general recommendation that it's not relevant for this. Okay, right? Slide given the presentation. Slide support. You should have your own speech. So and it's a support. Why Island doubt tax right? Right? Out of the executive position in a Vevulan presentation make a ban by audience right? Okay. But other technical part you have already covered. So, video presentation. Okay. Ten.
Yeah, making
So, in our scenario, we have companies. The services is otherwise known as Swiss company, Swiss investment fund, the company of LDB, Sri Lanka, Lanka Development and PLC, that's been the company, been very important in Sri Lanka. So these two parties were involved in the voting program, restructuring program. So, because we are doing that, so actually, I have been definitely now, now we have an independent consultant for this project. He was appointed as the lead advisor for this project as well. Also, he stayed during his contract. He was stayed at LDB and with full facilities as well, and by LDB. So, other one is LDB was given a consultant fee around 6,000, directly paid 60,000 to first lease account directly. Additionally, also it was purchased 20,000. So we was worth 12,000 with computerized account, computer equipment for this as well. So, why the essential incorporation access information is like was financial advisory services to Sri Lanka. If company is not resident in Sri Lanka and but it earns the money from activities carried from Sri Lanka to provide the services, and that the money supports Sri Lanka's source of export income. That income is taxable in Sri Lanka even if company made abroad or the payment is made outside the Sri Lanka. Right. Messenger. Distinction between the resident and non-resident. Non-resident status under Sri Lankan law. This question is governed by the Asian Government number 24 of 2017. Is crucial because it determines whether an individual tax only on Sri Lanka income or the global income. Let's look at how residently defined. And then an individual is considered as a resident if they stay in Sri Lanka over the 183 days or more within any meeting 1 month period. Other indicators include maintaining the payment from Sri Lanka, being a Sri Lankan citizen making efforts for the government. And on the other hand, when it comes to the non-resident patient, is someone who stay less than the 183 days, or else has no payment from here, or it's a foreign national, even Sri Lankan citizen can be treated as non-resident patients if they exist abroad there and make of the local ties.
Yeah, I'm going to explain the permanent establishment under the DTA. So the double tax under the Sri Lanka and Switzerland double tax avoidance agreement, the business profit from the foreign businesses are taxable in Sri Lanka only carries on the business through a permanent establishment. So what the permanent establishment means which can continue business of a foreign company in another country to which it carries on its business. So under the People Act number 24, 2017, section 28, it shows if a non-resident company has a permanent established in Sri Lanka, then the income connected that he is taxed in the same way as the resident company in Sri Lanka. In the Article 5 of the Sri Lanka Switzerland DGA, there are two key points.
The first one is the strength of a business. The foreign company has an office, branch, factory, or even project site in Sri Lanka, where regular business is considered a government established. But in this scenario, this company has a very office in Sri Lanka, so it not be. So the other one is dependent agent. The foreign company has a person in Sri Lanka who regularly acts on its behalf and has authority to sign contract for the company. That company creates a B. In this scenario, the SSL appointed the Stephanie in Sri Lanka who can negotiate and finalize deals for them. So the SSL is treated as a P in Sri Lanka. So the SSL needs to pay the tax at the same resident company in Sri Lanka. So that's what we discussed. I'm going to present about the fees, to non-residents tax relief. Look at the consultancy fees paid to LDB is a Sri Lankan company paid $60,000 for service. Since she is physically working in Sri Lanka, this is considered Sri Lanka source income. According to the section 85 of the Inland Revenue Act 2007, when a Sri Lankan company pays non-residents for service carried out in Sri Lanka, the company must deduct withholding tax for sending the payment up. If SDP fails to deduct the tax, the LTD itself becomes liable, and the Inland Revenue Department can recover the unpaid tax plus penalty from the company. Moving to the DTA. DTA between the Sri Lankan and Switzerland. The purpose of the agreement is to prevent the same income from being taxed twice. It allocates taxing rights between the two countries and provide relief either through credit or example. This is a slide of a summary of the tax implication of this company. Suppose the this service company's income of 225 lakhs should be taxable in Sri Lanka because it's have a permanent establishment in Sri Lanka. So the net income is should be taxed for 30% as a corporate rate. And also the Japanese payment 60,000 should be taxable as a consultancy income, and the LDB company mostly withhold tax should be at the withhold tax as for the income, and obligation is clear. Ensure withholding tax on payment to Ms. Stephanie, possibly act as a withholding agent, necessary income is direct, and report and remit the tax to IRS. Thank you.
Right. So, yeah, you have covered that, what the expected area, right? So, because they are sending their consultant, not that this time they are not sending their employees or consultants. When the period is 7 months, so automatically it's clear that permanent establishment. Yes, that consultant is also engaged with the service from Sri Lanka. He also liable to Sri Lanka tax as per the DTA, even as per the Labour law. So DTA can be applied. So based on that thing, they are likely to be work out. So, but in this case, you can do a small simulation because the details are given here and there. Total, so what they come to take this money, next one, that thing. In that context, it is expected to work out the liability. That has not been addressed, right? Because so reason is I purposefully given that period is 6 months. So July and thereafter they are working, and so you have to work out the tax liability for that particular period. Okay. Yeah, online. Yeah. Yeah, me. Oh, Sally, go, mama, lakukan apa nak? Ah, kan ya. Ya, mula beli kau jauh ni kan, ada tahu tu ya. Ada pen ni ke? Upload करे ना? उन पहाड़ का बना? तो पहाड़ का दे? हाँ? pen ni ke? Pen ni ke? Upload करे ना? हाँ, angkat angkat. Ini apa ini dia? Ah, pen ni ke dia ni apa ini? Wah, Windows tu kan? Okay. Ada tadi mana?
හැබැයි අපිට මේ ඉංග්‍රීසියට වචන කරලා English
Kolahane. Baik, start. Udah panas berat ini.
We take you through business profit. Explain what Shanka will explain the concept of management and then we take you through the financial management. So, I see the branch in Sri Lanka, and according to the given information, it has a net profit of 136.35 million and an interest income of 600 million. And to understand the bank's tax liability, we will look at two important legal frameworks, which are Inland Effect Act number 24 of 2017 and the Double Taxation Amendment Act number between Sri Lanka and China, it was in 2003, which came into effect from April 2006. To explain the permanent establishment and translate, Mike.
Agency incorporated in China and local branch in Colombo. Entire branch is established in China. Branch conducting is banking operations like accepting deposit and lending and other financial services. Staff senior member manager seconded from China, supported by local employee. In our case, according to the BTA agreement, China and Sri Lanka, in Article number 5, permanent establishment in defining. In permanent establishment means a fixed space of business through which the business of enterprises in wholly or part carried on the place of management, branches, and office, factory, workshop. In definition, Sri Lanka government and the BTA, China and Sri Lanka, and IRD Act number 2017, a fixed space of business to the which the business is carried on. According to the definitions, ICBC Colombo branch is a permanent establishment in Sri Lanka. When we go about this type of the tax implication of permanent establishment, Sri Lanka taxable profit is interest income generated in Sri Lanka, the income from services, profit attributed to the Colombo operation. Deduction allowed local business expenses allocated operation expenses in justification purpose. Taxation applicable 28 corporate standard taxation. Thank you.
Article 7 business profit. This Chinese bank has established branch in Sri Lanka. This branch is a permanent established bank in Sri Lanka. Therefore, under the Article 7, Sri Lanka can tax on this entity. For this is a banking enterprise. Therefore, the treaty alone deducts for normal business expense such as staff cost, administration cost. However, artificial charges such as head office management royalties cannot be deducted because this is a bank. One is Article 28, which relief for double taxation. This is bank branch already paid tax for the Sri Lanka government. Also, their head office has to pay tax for the Chinese. Therefore, Sri Lankan branch profit has to pay double tax. Therefore, to reduce that, Article 23 has introduced double taxation. Even the Chinese head office still has to report from China. Therefore, the credit is limited to the amount of Chinese tax that could be due to on the same income for the first 10 years. The credit can also include Sri Lankan tax, what is waived under the incentive scheme. I am asking my to continue this.
Basically, a profit before taxation, we have started the tax computation. What are the disallowed expenses? First, in the P&L, reflect staff salaries. Staff salaries we are deduct because these staff salaries include their branch office employee and the EPF, ETF. EPF, ETFs, we assume that these EPF, ETF are going to a CGI approved organization, organization. So next one, we are disallowed the donation expenses because donation expenses basically not incurred for the production of income. If there are any government approved charity donation or a government approved charity or a government donation, we can allow the under the qualified payment. So the next expenses is utility bills. We are assuming that utility bills are directly coming under the branch office expenses. The next expenses in entertainment. Under the section 195, define the entertainment expenses. We assume tobacco accommodation expenses are included. In that basis, we are disallowed in the expense. Other one is communication. Communications, we assume communication expenses also incurred for the branch office. Then that basis we are deduct the expenses. Office rent, if the office rent is more than 100,000 per month, we have to deduct withholding tax. The other one is finance cost and management fee. For the DTA, Article 7 mentioned that if the company interest paid by the branch office to head office is not deductible. So that basis we are dislodge these two expenses. And the admin cost allocation. So these scenario mentioned the branch of head office attributes some 10 million expenses for their branch office. We are at back because there is a apportionment for this the revenue basis or a head count basis. There is a proper apportionment need to get. So that basis we are calculate the business income under 30% tax rate will apply for this. Next part, we are reviewing. Over to you.
Yeah. Withholding tax, thanks Romani. Withholding tax overview. What is withholding tax? It's mean the way with the way for the governments to collect tax early instead of waiting people to pay later. The tax is cut off from payments like interest, fees, or profit, and also sent directly to tax department. The receiver only gets the balance. So this applies when money goes overseas, like interest, dividends, management fees, or profit sent back to the parent company. When talk about the branch profit remittance tax, when a foreign bank has a branch in Sri Lanka like ICBC, the profit they send back to their head office are taxed. This called branch profit remittance tax, or we can short form is BPRT. It is the rate is 40%. Can you Rumali? So when the WHT expose, we can say interest on loans 5% tax, management fees 14% tax, and admin charges could be 14%. Likewise, this is a WHT expose. The Jivanta will explain the output of this presentation.
Thank you, Gihari. Can you? Yes. Just has a time out. Just I will take a haircut of our presentation. The implementation of China and Sri Lanka DTT. Yes, can you hear me?
Yeah. Yeah, we can hear you.
Yeah, so the as a haircut of our presentation, I would like to just present the implementation of Chinese and Sri Lanka DGT. As you mentioned, as I mentioned, there we can see the tax rate source is 10%, and employment income is covered by Article 15.
Right, okay. So, I'm the friends, few things. So some area what you have mentioned is incorrect. So there is no 28% tax rate. It is 30% tax rate. Branch office is liable for tax at 30%, right? I have mentioned 28%. So other thing is that withholding tax, that's wrong. So reason is that you can see that this is branch office which is in the business of bank and financial. In that context, they can pay interest to their head office. Other than bank, Article 7 very clearly mentioned management fee, interest, unless it's a bank, they are not allowed to deduct that interest cost as per the China Sri Lanka. And therefore, interest cost they can deduct the deductible expenditure, but management fee there is not. The administration cost again, tax, and they are going to allocate head office expense to Sri Lanka. So, ඒක දෙවා බලන්න ඕනේ. අපිට කොච්චරක් අඩු කරන්න පුළුවන්. There is a provision in the Inland law. So it is 10% of the assessable income of the branch of it. Up to that level, they can deduct. Head office expenses. It's there in the article also. Article 7 says general administration expenses here. So there's a fair ground. So yeah, you can allocate because they are asking their plan to deduct, plan to allocate. It is not there in the income statement because it is there in that cost is there in the head office book, not in the branch office. From that topic, they are going to charge something, a portion to something to Sri Lanka expenditure, right? And the applicability of the interest, if they are paying interest to non-resident person, there is no withholding tax applicable. That is also wrong, right? This thing need to be corrected and put to the report and the computation side also. So other than this management fee is not a deductible expense as per the DTA. In finance cost, they can. The loan provided by the head office to branch, which is a bank. Article 7 I retake hada. Okay, right. Okay. Thanks. Well, you like no? What percentage for it? And percentage download for the idea of a print of PDF. voucher. කාර්ය වල නම් දන්නේ නැහැ. පහින් වෙලා නේ? ඈ? අරෙන්දන් මං කියන්නේ. මොකද වෙන නැන්ද කියලා. බලන්න ඔයගොල්ලෝ බලන්න. කරන්න ඔයගොල්ලෝ තාම වෙලාව ගන්නවා. මම නෙමෙයි. ඔයගොල්ලෝ විනාඩි 10 නාස්ති වෙන්නේ එක්කෙනෙක්ව. දෙන්නේ කියලා. ගන්න.
Presentation in Romanian, Sri Lanka, and income group member, and the allocation of the loan, because the tax magnitude to residents here, and the what is the application of the EPP, and margin therapy, status and indication of and the practical first of all, case study and the bicycle Romania fighting construction machinery and expanding to the Sri Lanka in May 2024. Model machinery in Romania for the Sri Lanka customers. Along the subsidiary of Lanka Construction Services, while CS business cost 5% target customer higher fee, and so while CS prohibited from the residential status of the as per the Sri Lankan law. YC is incorporated in Romania and therefore it is not resident in Sri Lanka. Under the Sri Lankan law, a company is resident not really incorporated in Sri Lanka or management of the control is not in Sri Lanka. It is not under the residential under the Sri Lanka. And the YC is non-resident in Sri Lanka. And permanent establishment and the as per the Sri Lanka law, that's the YLCS is resident company, so it is taxable on the worldwide income. And also, YLCS charge USD 30 to the customers, and the YLCS USD 20. YLCS 10 rupees, USD 10. And YLCS will tax in the corporate income tax rate in Sri Lanka on their profit. And the payments from the YCL and YLCS reimbursement cost 5% of their markup. And also, YCL invoices customer directly from the outside in Sri Lanka. There may be no withholding tax, and as well, it is cross-border payment for the goods, not services, rendered in Sri Lanka also.
Simplification. So, presentations for that, making domestic law versus trade. So, the why Sri Lanka's law taxes business. Sri Lanka's law tax residents of worldwide income. The treaty may reallocate taxing rights to Romania for some certain income like dividend and interest. And then for residents, we ensure that the Sri Lanka residents once income from Romania, Sri Lanka must grant for tax credit in that case. And for residents, the treaty ensures only one state can treat the person as a resident and for trade purpose, avoiding conflict with companies, so for non-resident, they are only taxed in Sri Lanka. Sri Lanka source, if they have an income from Sri Lanka, but the treaty can reduce source taxation, like capping it withholding tax. Worldwide income and the source of income is establishment. YLCS liability for the Sri Lankan bank for their service provided US take profit margins under the worldwide income. But there is no permanent establishment for YCL. Therefore, it has no tax liability for that. The Sri Lanka permanent establishment means it is a fixed place for the business. It means YCL has the office or branch. It is a permanent establishment. This scenario is no applicable. Dependent agent, under the dependent agent, there is no no dependent agent because he is the permanent entity. It is the incorporated one. YCL's machinery sale is taxable in Romania, but it is not taxable in Sri Lanka. Therefore, no any dependent agents in Sri Lanka. The machinery sales in YCL company total taxable in Romania. And the YCL is services and the installation income is total taxable in Sri Lanka at 30%. Only YCL machine sale is not taxable in Sri Lanka because there is no permanent establishment. And according to our scenario, the interest and the capital gain is not applicable. In Sri Lanka and Romania rubber taxation agreement. Determine the tax burden of your construction limited and is subsidiary Lanka Construction Services. YCL is a Romanian organization and it's registered in Sri Lanka for tax purposes. Business income from the sales of equipment is subject to taxation in Romania. In Sri Lanka, when tax YCL's public equity is determined to have a fee in the country, since YLCS is resident in Sri Lanka and YCL is in Sri Lanka, that's don't have a fee. YLC is being Sri Lanka entity is considered to resident for tax purposes, therefore it is taxed on Sri Lanka's corporate income on its global income. Income from installation and operation services is taxable in Sri Lanka and the YCS revenue are taxed primarily in Romania and YLCS service income is taxed in Sri Lanka, so that the same income is not taxed by both countries.
Simple question. Whether YCL, that is Romanian company, has a permanent establishment in Sri Lanka or not? Confirm. Why? That's again. They have a subsidiary in Sri Lanka. They have a subsidiary in Sri Lanka. Right? So the what they have?
They are Sri Lankan
Company. So what business they are doing? It has two parts, right? Yeah. One thing is they are selling machinery Another thing is there is a without the installation and that part is complete, that machinery cannot be used. So there is a dependent thing, right? So selling machinery is not liable for that. That's fine because contract is signed outside Sri Lanka. It's a delivery of goods. There is no source in Sri Lanka. So section 79 වල කියන source in Sri Lanka කියන එක 79 වල කියනවා. 73 වල. ඒකෙන් කව වෙන්නේ? non resident person ට ලංකාවේ source එක තියෙනවා income එක generate වෙන්න ඕන. income එක generate වුණායි කියන එක section 72 and 73 refer කරන්නේ. එතන කියන්නේ නැත්තම් වෙන්නේ නැහැ. එතන නැත්තම් ලංකාවේ income එක generate වෙන්නේ නැත්නම් liable වෙන්නේ නැහැ. So එතකොට selling of article කියන එක එතන කව වෙන්නේ? එතන there is no. But second thing, for that thing what they are doing. So YCL decide to several countries and expand its business to stand notable YCL currently legal person in Sri Lanka. The national preparation point in fact YCL is evaluating business model. Under that, YCL manufacturing machine in Romania directly into the input customers of Sri Lanka. Installation and operation service will be provided to a company incorporated in Sri Lanka. What they are going to do? They are going to incorporate a company in Sri Lanka. Right? Just because of a having company and the subsidiary company, there is no chance to create a permanent establishment. Have a dependency agent can create a full. Shareholding is a control of the permanent establishment created. But they are dependent agent. And a company will be incorporated under the wireless the Sri Lanka company. It will provide the installation and operating service to customers. So then what Romanian company, Romanian, right? Company gave goods to Sri Lanka, machinery, Lanka company installation part take correct? ඒක තමයි කරන්නේ. හැබැයි දැන් අර ඉන්කෝපරේට් කරා කියලා මෙහි two different entities දැනට. ඊට පස්සේ කියනවා it provides installation and operation service. YCL, a Romanian company, will reimburse the cost plus margin. At US, the fee charged for the customer for the same will be 30. Will YCL, that Romanian company, will train the employees of Sri Lankan company. Train her. And provide detailed instruction and manuals to provide the support service. Technical support is there. YLCL, that Sri Lankan company, will be prohibited from providing these services to any other parties in Sri Lanka. Then they have sticker, they have business card, one business card. They have business. So it's a dependent agent. Agree or not? Independent agent ko हम यार ओने देख रहा हूँ. Dependent agent. A point एक थोड़ा critical. Dependent agent के क्या नहीं क्या? मांगे बोले ना ये तो क्या होते? अभी subsidiary का लंका trade करा के dependent agent बनना है. बाइक example लगाते ये यार ये business है क्या? मैं यार मेरा business है क्या? දැන් dependent agent වෙන්නේ මොකද? අරයාගේ business එක තමයි ලංකාවේ කරන්නේ මෙයා subsidiary එක through. So subsidiary එක එයා කරන්නේ restrict කරන business කරන්න බැරි එක. ඒකට අන්න dependent වෙනවා. clear? එතනින් තමයි agency relation permanent establishment පුළුවන් subsidiary එකක්